Rise in crude prices last session, but certainly looking to the US, increased drilling activity, uncertainty over Libyan and Nigerian production cuts clouding the supply outlook. Pete McGuire from XM.com is live. Pete, where say you to break this logjam on just a very narrow traded band, but if anything, the path of least resistance still seems to be further weakness, not price strength for North Sea Brent?
Well, good afternoon, Carson. You'd have to agree. I mean, you know, when you see what happened last night, it was very flat in New York. It's been a pretty uneventful day in Asia today. The bears, I think, running the show at the moment. We're down 18% from the start of the year as far as futures prices. So that's a fairly heavy correction. But there's certainly the volatility is remaining, and I think that there's going to be a very interesting meeting come 24th of July in St. Petersburg. Russia's sitting there, certainly what happens with Nigeria and Libya, and more importantly, what happens as far as OPEC on these production cuts. So there's a certain amount of uncertainty, and which in turn, of course, leads to volatility.
Hi Peter, Tony Farnham here from Patterson's. It's interesting, Russia's already said we're not going to be partaking in any further production cuts. And I noted too that last night you had the Kuwaiti oil minister saying, well, we're inviting Libya and also as well Nigeria to discuss where they're at with their production levels. I wouldn't think there's much chance of both those countries coming to the party with cuts anytime soon as well. So really, it's still the same problem. We've got OPEC plus its friends producing to a level, but shale oil is still on the other side, adding to rigs and adding to supply. Where are we going to break the nexus?
Well, I think that's exactly a wonderful summation there, Tony, because unfortunately, if you're a producer and you're at $50 or $55 a barrel, then there's certainly a handbrake on all those guys. A great proportion of those rig, as far as the rig count, those guys are, you know, $40, $41, $42 a barrel as far as retrieval, so they're still making $1 at the moment. Pardon me, but the uncertainty naturally is what goes on with OPEC, where does Russia play, and what happens with Iraq. I think that's really a bit of an outlier at the moment. It's too early to call. Certainly in the sense of what's going with ISIS, if that's all that matters being put to bed over this Northern Hemisphere summer, then I think that you're going to see Iraq say, we want to see higher numbers as far as our production. So in turn, I think that's going to add another cat amongst the pigeons.
So St. Petersburg, July 24th, in your calendar for an informal meeting. What realistically do we expect there to happen for these producers?
Well, if Russia, and we take on board what their situation is, Novak's called it, and you know what goes on. If the Russians sit there and they say they're not prepared to cut any further, what happens as far as the Saudis? The only, I think, outlier is if we see something dramatic happen as far as hurricane season or geopolitical tensions. We've lived through Qatar, we've lived through North Korea in the last couple of weeks. Nothing's really spiked it up. Let's turn to Mother Nature. If that doesn't add something to the horsepower over the next month or two, then those talks in Russia are going to be very, very much on that centre line. Where do we go forward? Do we hold off until November as far as production? And hopefully we see a higher price, Carson.
Tony, your views even therefore on the producers. I mean, back on these, you're looking at in terms of most shorted. I mean, have people just lost interest, or how do you understand it alongside a metric like that? You know, the most shorted plays, they're not, in fairness, you've got oil search number 8, but that's about it. So how do I understand that?
Yeah, look, we're saying in another segment there, I still see stories, long-term investors in the Woodsides and the oil searchers, but people looking for a quick buck in terms of a sharp increase in oil prices. Really, aside from geopolitical events, I just can't see how it's possible anytime soon, even with the global economy showing continued signs of life.
Pete, talk to the ag story. Try to understand the idea of what the US is offering up. We are, on the one hand, getting calls for an oversupply, that inventories are running high, but then we keep hearing of drought talk back in Australia. Yeah. I mean, how do you pull all of the story together?
Well, I think if you look at the US first, and you're, you know, right on target there. As far as production, we've had bumper seasons year on year over the last, say, 3 to 4. And that's been wonderful for stockpiles, and more importantly, farmers have had, you know, wonderful crop yields. Now, if we see weather conditions tighten over that again the northern hemisphere summer, over this period, then that's going to cause concern as far as production. It's a wait-and-see approach. Soil moisture is a little bit tight at the moment. And the other side, of course, is you've got growing consumption across that whole European and Asia basin. So I think as far as feedlot, as far as everything's concerned, it's a good place to be at the moment as far as farming. The other side is, you know, price volatility. We're well off those highs that we experienced a few years ago. And let's see what happens with the Aussies. Let's see what happens with Ukraine and the other major growers across the world.
Tony, your perspective on this, even on a listed play here, because the fundamentals to what we're hearing from Pete there, stockpiles in the US running at 11-year highs. Now, New Farm's cost-cutting effort. Yeah. Some I've spoken to today, this is the dilemma. How do you get your head around this as an investor? Some say it's nearing an end, some say it's got more to go. Now, that's as fundamental as disagreeing on Qantas's cost-out program. Is that nearing an end, or has that got more to go? I mean, conventional wisdom is that by the end of this year, the Alan Joyce cost-out program has run its course. But I'm just more interested back on New Farm. Why would you fundamentally look at the settings on that and say cost-out's near its end, 11-month high on stockpiles in the US? Where's the case to be made? Really,
again, discussing there earlier, I prefer not to be in that space at this point in time. If you truly believe we're going to have a good season in the Australian market, where you look at the grain corps and these sorts of guys that take a clip from the marketing per tonne, the handling per tonne, and those sorts of things, because they enjoy that volume effect, and of course as well in some other areas beside. That to me is more a play you do if you think we've got a good season coming up.
Pete, go outside the ag space, back in, for instance, even on bullion. What are we seeing here in terms of a US dollar play?
Well, you put your mind back, the best part of 35, 36 days ago, and gold was sitting just on, $12.97. I thought at every chance you're going to punch through 1,300. Now you're saying it's going to punch to the downside through 1,200. So we've seen a pretty big washout, US dollar return as far as, stronger than expected numbers coming out, as we all know, from Europe and the US. And that's really caused some weakness across that whole bullion sector. Silver's been sold off as well. There's nothing really there to drive it, but we have mentioned over the last couple of weeks together that, this time of year, June, July, is normally a flattish sort of time, or a washout time, if you look at the fundamentals and you look at that historical data versus, earlier in the season, the Januaries and February. So I think where gold's looking at the moment, if it gets support around, 1201, 1202, then it might hold. Was down at 1204 in New York overnight, bumped up on Asia at about 1211, I think it's currently sitting at about 1211. So a lot of, again, volatility, uncertainty, and you may see further softness.
Peter, the problem, isn't it, with Treasuries curves at this point in time? It seems as though there's a bit of an urge to sell in those markets, and of course a couple of central banks increasing rates would add that to that urge even more. Surely that's going to put gold on the back foot more.
Well, exactly, Tony. We've had a few washouts this year. We had, the 1170s and lower over, the January or I think February period, and then we had another, weakness in May. It boosted back up in June, and then it's come off again. So there's certainly movement. If you look at it on a graph, it's been tremendous as far as a trading opportunity. But I think you're right. Those central bankers lifting rates up, that's going to add to the dollar, and of course, subsequent weakness as far as bullion.
It's interesting, back even on iron ore, Macquarie's bearish. It's saying, look, we take note of implications of accelerating PMIs. We're looking globally on that score, but note that US manufacturing is weak, and therefore we retain our iron ore bearishness. It's kind of interesting, is it not? Never mind the Chinese connection, because you've certainly got a stockpile story there to work through. I mean, to offset that, if the US is looking weak on manufacturing, Tony, where's the case to make for iron ore?
Well, I'm struggling to see the recovery we've seen over more recent times. Another 2% gain last night. For me, the challenge continues to be supply on ports, still quite large, and also as well I can't be convinced that Chinese steel demand as well as supply is going to continue onward and upward. I don't know what Peter's view is on that.
Yeah, Pete?
Well, you know, stockpiles are at record levels. We all understand what's happened. I mean, we're producing at, you know, incredible numbers and being shipped over there. But the issue at hand is, what's the forecasted growth? I still believe that, you know, there's a lot of building to happen across the world. That storyline as far as steel and so on, sure, it'll go through a little bit of a hiatus, and we have, you know, times of, you know, markets in misery. But when the sunshine happens, and there's a lot of happenings going on as far as Asia and moving into India and so on, I really do see that, you know, growing consumption is going to be there. Automobiles, everything to do with steel is only going to uptick, I think, over the next, you know, 3 to 5 years. And it'll be on the back of crude oil, electricity consumption, everything's growing, population grows, and in turn, so does, you know, demand.
It was interesting though, Peter, we had our own official forecaster downgrade their expectations for iron ore prices.
Well, that's right, but, you know, that can be short term, Tony. I'd say, you know, over the next 12 to 18 months, but I think further out than that, the overall demand picture, I don't think is going to wane too much. And as I said, you know, there's a lot of building to happen, and more importantly, I think from a consumption side, that's only going to increase, you know, over the next decade.
Pete, we might leave it there, but thank you as always. Pete McGuire, XM.com live, and our Sydney CBD studio.